Good morning. My name is Joe Mercurio. I see a lot of familiar faces here. Thank you all for coming to this program that's sponsored by the HR department and particularly the benefits office. I want to thank Nemette and Manuel and the others who have worked hard to put the program together. And I would like to move right ahead into the program. So let me begin by saying that most of you I know are familiar with TIAA-CREF. In 1918, the Carnegie Foundation established the Teachers Insurance and Annuity Association, a fully funded system of pensions for professors. And since that time, of course, it's expanded. Funding was provided originally by a combination of grants from the foundation and the Carnegie Corporation of New York, including initially a $1 million grant. TIAA, which had operated since its founding as a pension investment program of fixed securities, was the first organization to create the variable annuity contract. That was back in 1952, and was the first to blend fixed income and equities into a retirement portfolio. In the 1970s, it was one of the first companies to use an extensive portfolio of international stocks as part of its investment strategy, and in 1988, it began expanding its variable annuity offerings even further. In 2002, TIAA again increased its mutual fund offerings to broaden investment opportunities for participants. In February of 2008, TIAA ranked 9th overall out of 67 mutual fund families, so it's large. TIAA-CREF has been an innovator historically, but always with the goal of protecting the employees of their non-profit affiliated organizations like Boston University. Today I have the privilege of introducing Roger Ferguson to you. Mr. Ferguson joined TIAA-CREF about a year ago, bringing broad experience in financial services, strategic management, and economic policy. Before joining TIAA-CREF as President and Chief Executive Officer, Mr. Ferguson served as Vice Chairman of the Board of Governors of the U.S. Federal Reserve System. He was a voting member of the Federal Open Market Committee, and he served as chairman of the Financial Stability Forum. He also chaired the Federal Reserve Board's committees on banking supervision and regulation, payment systems and policy, and Reserve Bank oversight. Recognized for his expertise in these areas, this past February, Roger Ferguson was named to President Obama's Economic Recovery Advisory Board, something that I know we are all interested in hearing about. Since last fall, under his leadership, TIAA-CREF has intensified its outreach to participants and to plan sponsors in person, over the telephone, and via the web. The company has also provided a wealth of information to help individuals navigate these difficult economic environments that we're all in, with insights and analysis on retirement income, market volatility, and investment performance. TIAA-CREF has also escalated its efforts to oppose genocide in Darfur. The firm is placing additional pressure on companies to improve their stance on Sudan, and plans to divest from companies that fail to take meaningful steps to respect human rights in the Darfur region in general. The company has also maintained its financial strength, a significant achievement in these precarious times that we're in, and this was most recently noted by Professor Pennywise in the current issue of the Chronicle of Higher Education. Roger Ferguson has a lifelong tie to academic community. He holds a BA, a JD, and a PhD in economics, all from Harvard University. He is president of Harvard's Board of Overseers and a member of the Board of Trustees of the Institute of Advanced Studies. We are very fortunate today that the reins of higher education's premier retirement plan are in the hands of someone as competent as Roger Ferguson. So without any further ado, Roger.
So, thank you very much for that kind introduction. It is always a pleasure to be at BU and to see so many faculty and staff. And I must, in the spirit of transparency, talk about also seeing a friend of mine, a person I've known, I won't say for how long, but let's say since we were 19, we'll put it that way. How's that? Manuel Montero and I were undergraduates together the same year, and I'll disclose something else about him. He is married to the sister of another good friend of mine from Harvard, so I feel as though I know him really well. I also want to take a moment to recognize another colleague and friend, Professor Zvibodi, whom I think many of you know, one of the great experts in retirement issues, and he and I are hoping to see if we can't share a lot of notes and work well together for everyone's benefit. And I would obviously be remiss here in Boston University if I didn't say something about a sport that I love and which, frankly, I've never played very well, which is ice hockey. So congratulations to all of you on a superb victory. And in doing that, yeah, give yourselves a round of applause. This gives me a chance to introduce someone whom you probably don't know. Erwin Martin should stand up. Erwin is a senior leader in our company, but I've asked him to stand up at this moment because Erwin was a co-captain of the University of North Dakota team in 1980 in ice hockey. I won't make any funny comments about Erwin's lovely smile. It's all real, though. It's all his stuff. Anyway, it is a pleasure to be here, even though these are obviously turbulent and uncertain times. And what I like to do today in my time with you is go through a few prepared remarks and then leave plenty of time for questions and answers. And in my prepared remarks, I'm going to talk a bit about the economy and the economic outlook, and then talk about 4 or 5 lessons that I think we've learned from the experience that we're all going through. So let me start with the economy. It won't be a surprise to you to say that we are in a very deep recession. Some people would go back to 1981, the recession there, to see an unemployment rate that was around this high. But indeed, others say you have to go back several generations to find the kind of turmoil that we're currently confronting. The 81 recession was one that was triggered by the Federal Reserve to drive inflation out of the economy. This recession started in the housing sector. The housing sector had experienced a bubble. Housing prices came off quite dramatically. And unfortunately, the bad news is that we do not yet see, in my judgment at least, a bottom to the housing sector. Some of you may know of the Case-Shiller Index. The Case-Shiller Index tracks 20 metropolitan areas and the house prices in those areas, and it is at its lowest point that it's ever been since 2003. So the housing sector, which started this, appears to be very much at the bottom. I don't know if it's going to go further down or up. We'll talk about that in a minute. In addition to what we see in housing, we've seen more broadly a broad destruction of individual household wealth. The Federal Reserve, where, as you know, I used to work, in its latest report shows that household wealth fell about $11 trillion in 2008. That's a decline of nearly 18% from the prior year. And this obviously will play very importantly into the question of retirement, which I will certainly want to touch on. In addition to that, we see that consumers have been very reluctant to start to shop again. And there are a number of reasons that explain all of that. But one of them is actually that we are surprisingly in a position where consumer debt is relatively high versus household income. So the debt-to-income ratio, looking at the after-tax income, is at around 123%, which is to say if one looks at the whole income that is earned by household sectors after taxes, it is less than the entire debt that's outstanding for households. So I think one of the reasons that households have been reluctant to start to shop again and to spend money again is they already are relatively indebted and have to figure out how to get their balance sheets back in balance, quite literally. And this has shown up not only in retail sales, which have been relatively flat, but also we've seen that the creation of consumer credit is way down. And then finally, I would say there's the issue of job loss. Job loss is one of the indicators of a recession. This recession started in December of 2007. Since that time, the U.S. economy has lost about 5.1 million jobs, and almost 2/3 of those jobs, let's say around 3.5 million, have been lost in the last 5 months. And in March, we saw the highest unemployment rate that we've seen in 25 years. Okay, so I've started with all the glum news, just to get you in the right spirit, to turn to something hopefully a little better. Let me add one other factor that's on the glum side, which is I and many others describe this as a global recession. This recession is indeed global because we see across the globe that many economies are flat on their backs in Europe, Japan, et cetera. Having said all of that, You will also notice, for those of you who read the paper, and I'm sure many of you do, that there are, coming out of Washington and a number of other places, some early inklings that perhaps this is starting to bottom out and maybe even turn. Ben Bernanke, I guess last Tuesday, gave a speech. He's the chair of the Fed and a TIAA-CREF participant, I must say. Gave a speech in which he said he saw perhaps some glimmers of hope. I think he's used the phrase green shoots. So what are some of those early and tentative signs that maybe things are starting to turn and maybe the gloom is lifting? There are a number of them. First, I talked about the housing sector. While prices are down and may continue to fall for a little while, it turns out that the sales of new homes and existing homes have turned up, and they've risen more rapidly than expected. And that might be the result of these low prices and relatively low interest rates. All of you are quite aware, because I'm sure you watch it maybe more than you should on a day-to-day basis, that the equity markets are trying to rally. They've been up, I think, 5 out of the last 6 weeks. Yesterday, they were up a bit as well. And that obviously will then eventually have an impact on consumer confidence, and it will have an impact on the willingness of businesses to spend more. We also have seen, as recently as this morning's paper, some early signs from business leaders. There was a poll last month from the Business Roundtable in which many CEOs were forecasting a continuation of the bad times. What we saw in this morning's Wall Street Journal, for those who read it, is some business leaders are saying, well, maybe things are really starting to turn. Not everyone is saying the same thing, but it's another one of those, if you will, green shoots. And finally, for those who watch other kinds of markets closely, there is some sign that the various packages that the Federal Reserve has created to support markets are starting to work. And certainly many of you are not experts in these things, but it's certainly true that in the short-term money markets, we're starting to see some, again, early signs of some thawing. And so while the overall story is, yes, we are mired in a recession, it may well be that we're seeing the early signs, not just of spring here in Boston, but the early signs of a turnaround in the U.S. economy. And finally, I must say, my successor as the Vice Chairman of the Fed yesterday gave a speech in which he also said that he thought he saw some early signs of a turning. So it may well be that the gloom is starting to lift. Now, a number of people ask, well, when will we know that things really have turned? And I think there are 3 or 4 signals that will tell us that actually this really is fully turning. One is we'll start to see fully liquid markets where individuals, households, and businesses can borrow and lend at prices that really reflect their underlying risk, as opposed to a great deal of risk aversion that exists now. Secondly, I talked about housing. I do think a sign of real stability is some stabilizing in house prices, and that may be already starting to occur in some markets. I've heard anecdotal evidence from California, for example, that maybe house prices are starting to bottom out. The third thing that I think will be an important sign of stability is something that a few are already starting to talk about and may be out there, which is rising corporate earnings. The banks have been issuing some earnings, some of them more positive than others, and we're now in the midst of the earnings season, as it's called. Over the next week or two, we will get a large number of earnings reports, which will give us a sense of whether or not earnings are starting to turn up again. And finally, and most importantly, in our society, which is driven 70% by consumption, we will know that things have started to turn when we start to see rising consumption again. And so there are many, many things that one has to take a look at. But just to conclude on the issues of the economy, I would say, yes, we're mired in a recession. It is global. The outlook is uncertain, but we're starting to see perhaps the early and tentative signs of some improvement, but I emphasize early and tentative. And so it's something worth watching for the next several months to see if this actually is going to be turning. I would finally close on this part by saying many forecasters, the consensus among economists is that indeed we will see a second half of growth that is higher than the growth in the economy in the first half of the year. So against that backdrop, obviously many people say, well, what are the lessons that we can learn from this experience that we're going through, this once in a generation, maybe once in 2 or 3 generation experience? And there are 5 lessons I'd like to focus in on. 3 of them have to do with corporate governance, and then the 2 have to do with something that's even more important than that, which has to do with individual finances and financial literacy. So first, on the corporate governance issue, One of the first lessons is that we clearly had a failure of corporate governance at a number of levels. There is much discussion in papers around executive compensation. It is quite clear that senior management did not put in place executive compensation structures that aligned the interest of shareholders in the long-run performance of a company and the interest of individuals. We had in Wall Street and a number of other places, frankly, that have similar kinds of characteristics. Individuals had the opportunity to take home fairly large pay packages, often in cash, not necessarily tied to the long-term performance of their companies or the decisions that they had made. And so one of the clear lessons is that we need to rethink executive compensation, not in the way, in my judgment, that we're having hysterical reactions, but in a much more thoughtful way that gets executive comp throughout organizations aligned to the long-term interests of an organization. In my own company, TIAA-CREF, much of our compensation is delivered in a deferred package that pays out actually at the end of 3 years, and the Board of Trustees ultimately has the ability to determine how that might rise or fall during that 3-year period. And so our incentives are very much aligned to the long-term interests of the company. Having mentioned the Board of Trustees, the issue of corporate governance leads us to the second question, which is where is the Board of Directors? Where were the boards of directors in a large number of companies during all of this period? And one has to be careful because the directors are clearly not responsible for day-to-day management, but they are responsible for making sure that institutions have put into place the kinds of systems and mechanisms that do align behavior of the individuals who are employed with the long-term interests of shareholders. In America, as you well know, we have a representative form of corporate democracy, as is true of our democracy overall, and so shareholders vote for the directors with the expectation that directors will exercise the right kind of fiduciary duty and make sure that systems are put in place to create long-term value for prudent risk management, et cetera. One of the ways that we have been focused on that is what is called SayonPay, which is to say we believe at TIAA-CREF that shareholders should have the right to vote on not individual pay packages, but the structure of compensation. And we have been first eating our own cooking. In 2007, we were the first to give our participants, people such as you in this room, a chance to have a vote on our compensation structure. And we have been encouraging that for a number of other companies as well. We have also been, at our company, very active in voting our shares to send what we think is the right kind of signals to boards of directors if, in fact, there's some concern about whether or not they were focused in appropriately on their fiduciary obligations. And so last year, we voted our proxy against the audit and risk committees of a number of companies, including Bank of America, Washington Mutual, Morgan Stanley, Citigroup, Wachovia, and Capital One. In some cases, we were in the minority, literally 10% of the vote or so, but nevertheless, we did express our dissatisfaction with some of what we'd seen from management and boards of directors. Second lesson is on risk management. I introduced Erwin Martins, who is a senior part of our risk management team at TIAA-CREF. He is the embodiment, I think, of many of the things that can work well in risk management. But one of the lessons I think that we have, and there are 3 around risk management, first is there really is the need to have an understanding of the underlying risks in a portfolio that an institution may invest in. As all of you know, there are many companies that invested in structured securities, which you've read about, based on a rating agency's ratings, without having the ability to peel back the onion and understand what was likely to happen in the underlying securities that were going to lead to the expected performance. Therefore, clearly a failure to really understand the risks that were being taken on. The second lesson with respect to risk management is that one needs to have not just a good risk management team, but you have to have a good risk management culture. So that the entire institution is listening to what their risk management colleagues have to say. Yes, sometimes those relationships can be tense, as we know, but they should be mutually respectful and constructive. And it's very important that the risk management team be brought in to any major decision and even small decisions. And frankly, if need be, have the right to hold up, in soccer parlance, the red card, to say, no, we really don't think you should do that. And this goes to the third thing, which is you also need to have risk management structured in the right way, reporting directly to the CEO with access to the board if necessary, so that risk management is an equal part of the discussion and not a subordinate part of the discussion when it comes to making important investment decisions. So you need risk management culture, you need a structure, and you need individuals who are qualified to do the job of risk management. And obviously we have seen that in many companies, all three of those things did not coexist to the unhappy result for the shareholders and in some cases for the company themselves. The third major lesson out of this crisis that we're dealing with is the importance of trust. I gave you a number of macroeconomic statistics, but ultimately, if you put it all together, what we are dealing with to a large degree is a crisis of confidence. Individuals, households, to some degree management is uncertain who can be trusted at this stage. I talked a bit about the issues of having AAA ratings evaporate overnight, and many had put their trust and confidence in the rating agencies. That may not have been very, very wise. And now I think the entire financial services sector is trying to think about how do we regain the trust and confidence of the investing population, of participants, of our own employees in some cases. And we've discovered a couple of things. One is, not surprising, trust is extremely fragile. It takes many, many years to gain it, and it can be lost literally in a matter of minutes. The next headline can undercut trust that one may have. But secondly, we have also learned that it is our most valuable asset, along with the people who work in our companies. And so now it is up to the financial services sector not just to right itself in the sense of balance sheets, income statements, returning to profitability, but to right itself in a much more important way, which is to regain the trust and confidence of Americans from the White House through Congress out to Main Street. And this is, I think, an incredibly important lesson. I think financial services companies recently have forgotten or had forgotten how much their viability depends on the trust and confidence of counterparties, how much their viability depends on the trust and confidence of those in the government. And it is going to be very important for all of us in financial services to make sure we maintain your trust and confidence. Let me go to a couple of other lessons that may be a little closer to home in addition to those broad macro lessons. One is the importance of financial security. I talked earlier on about the destruction of wealth, $11 trillion. I also talked about the debt-to-income ratio at 123, 125%, more or less. Let me stop and take 1 minute on the question of what does this destruction of wealth mean for people who are at or near retirement. There's one study that I've seen that shows for individuals who are the older employees, it will take at least 2 to 5 years, to recover their retirement savings that they lost in 2008. That calculation depends importantly on 3 major assumptions. One is that employees continue to hold equities and not take an inappropriately conservative posture. 2, that they earn a return of at least 5% annually, which, as V will note, is not the easiest thing to do, clearly in these troubled times. 3rd, and most important, that people continue to contribute to their retirement plans, that one continue to save. And unfortunately, some trends are running counter to these. One concern I have is that individuals will try to time the market, stay out of the market till just the right time, and then jump in, perhaps with too much exposure to equities, in a desire to sort of catch up from the loss that they've experienced over the last year and a half. This is a very, very dangerous thing to try to do for individuals and, frankly, even to some degree for professionals. All the data indicate that the following thing is true. If you had invested $100 in the Dow in 1900, so 109 years ago, or 107, you would have accumulated about $25,000 by the end of 2007. So $100 in the Dow, 1900, would have been $25,000 by the end of 2007. if you had missed the 10 best days in the market during that period, you would have accumulated only about 9,000. Put it another way, a large chunk of any return in equities comes from not timing the market because there are 10 best days that account for the vast majority of the return that one would get from equity investments. And if you had missed 100 of the best days, 100 of the best days out of the last 107 years, 100 days only, you would have ended up with less than you started with. You would have invested $100, you would have ended up with $78. This tells you the importance of doing something which I've described to a lot of people. Though your plans may have changed, your plan should not change. It is not a time to panic. It is not a time to think that you're going to be smarter than the market. It is not a time to think, I'll get to cash now and then I'll throw it all back into the market at the right point. Because the probabilities are, frankly, that you'll miss the 10 best days, probably miss the 100 best days. So market timing is not the way to get through all of this. You have to be careful about your investment strategy in an effort to recoup losses because you will jeopardize more than you can gain. Another trend that I will say is worrying me a bit as I think about retirement is the issue of what individuals are doing in terms of contributions. Since January of 2008, doing surveys at least, 20% of workers have cut the amount that they contribute to their retirement savings, and another 5% say they plan to do so over the next 12 months. It's obviously understandable. These are difficult times for sure, but one has to follow your plan. If you cut your contributions at this point, and I know people are making tough trade-offs, if you cut your contributions with respect to retirement, it will prove to be very, very difficult to make up the loss that we've all experienced over the last few years in that period that I've talked about, 2 to 5 years. The other trend that worries me is that more than a third of U.S. employers have reduced or eliminated matching contributions, and nearly a third plan to do so over the next 12 months. And again, this is not a criticism of employers. Employers have to make tough calls. We do out of my own shop. All institutions do. But if we think about regaining retirement savings over the next 2 to 5 years, it is important that we all stay on track and stay on plan as best we can. And so what worries me when I think about the fourth lesson here is that we're confronting a number of short-term decisions that could have very detrimental long-term impact. That brings me a little closer to my own shop, and I'll just say a word about TIAA-CREF, and since we are the largest provider of retirement services in the not-for-profit sector. And I'm going to read a quote from Bill Greene, who is the gentleman who created the variable annuity that underlay CREF back in 1952, and he had a PhD in economics from MIT. And here's what he said, quote, "We should try to design a retirement plan to work well in times of peace and war, in times of inflation and deflation, in times of depression and prosperity, and all the other words used to describe and explain the volatile nature of the American economy." That is the nature of TIAA-CREF. Those words sound very modern and current, I'm sure. Dr. Greene spoke those words in 1954. So that is the nature of the company that we represent here. So let me think about what retirement should look like. I've described it as a retirement system for the next century, the 21st century retirement system. And I think that system would offer a number of features. And Zvi and I may have some discussion around these. First, I think it's very important to have automatic enrollment and automatic savings. One of the lessons of behavioral economics is that inertia is very powerful. If you don't get individuals into the savings plan through an automatic enrollment and wait for them to opt in, you end up with a worse result. And then if you don't have their contributions increasing as their earnings and their ability to contribute increases, they end up suboptimal. So the first is automatic enrollment, automatic savings. I'm pleased to get positive feedback from Zvi Voti here in the front. Second element of, I think, the modern retirement system is you really need broad diversification across a range of asset classes. One of the things I think people learned is they had what they thought was diversification because they had a little bit of fixed income. Then they had different equity styles, so value investing, in growth investing, and international investing. And what we discovered over the last year and a half, as an economist would say, is that when troubles occurred, the correlation across those strategies went to 1, which is to say they all performed in a similar fashion, unfortunately negatively. So broad diversification means, yes, equities, as I've said before. It also means fixed income. It means thinking very much about protection for inflation in the form of TIPS or real estate or other alternative classes, which have gotten a bad name to some degree, but I think are an important part of the solution in the right set of hands. And so you need to have broad diversification, not just in the liquid markets, but also TIPS, which will protect you against inflation, real estate, which has an inflation protection component to it, and perhaps other alternative investments handled smartly and appropriately with the right focus on risk and return. The third component of, I think, of the modern retirement system is objective, personalized investment advice. I think one of the things that we've learned is in the world of the 401k, without much advice, people do the best they can, but you end up often making very, very bad decisions. But let me emphasize what I'm talking about. I'm talking about objective advice that is personalized. And in my judgment, objective also means non-commission. So the person giving the advice does not get paid for your particular action. They just simply get paid a base salary. The fourth component of a solid retirement system that I think we've learned over the last 2 years is there's an important need to have the opportunity to retire without worrying about health care. Healthcare costs are a major surprise in retirement. You need to start to save for retiree health care as soon as one possibly can. And the final component of a good retirement system is some form of guaranteed income. If one thinks about life and retirement, you'll have things that you must pay for, call it room and board, and then you'll have the variable expenses, the nice things to have, travel, transportation, theater, etc. You want to make sure that component of your retirement income is guaranteed, and then some of it may well be variable to get some of the upside. Obviously, guaranteed income during retirement, guaranteed income for life, basically means in the modern world having an appropriately priced, low-cost annuity. And so those are some of the things that I think are very important as we think about both rebuilding our retirement savings and also planning a retirement system for the 21st century. And let me close with the last and most important lesson, which is the lesson that I think all of us share in common, the lesson around higher education. It will not be a surprise to any of you, and it's certainly not a surprise to me, to know that many, indeed all of our institutions of higher education are trying to understand how to get through these tumultuous times. Those that are very endowment dependent have seen a decline in their endowments 25, 30%, and they have to figure out how large a draw that they want to have, and what do they do to cut back on their budgets if they're very endowment dependent, let's say 20, 30, 40% of their operating income coming from endowments. Those that are very driven by tuition are certainly asking questions about what is the enrollment going to look like next year, and are we going to see a big increase in the demand and need for some form of assistance, and how are we going to cover that? Institutions that are big research institutions, I think, are wondering, well, gee, it looks as though the federal government is going to increase research expenditures for a couple of years. How do we manage that? And then how do we manage the tail off? Okay, so all institutions of higher education are struggling through these uncertain times along with us. And all of us know they're contemplating a number of things that are very challenging. Furloughs, layoffs, perhaps, certainly salary freezes, a number of challenging decisions. Having said all of that, I think it's quite important that we be very optimistic about the future of higher education. Because in the long run, the ultimate wealth of any society, and certainly the ultimate wealth of the American society, is driven by our ability to create human capital, and we do that through the education system. And it may be at superb private institutions such as BU that have a strong focus on research and classroom learning. It may be at other institutions that have a focus on the combination of experience and classroom learning. Obviously, in that case, I'm speaking of, in this city, Northeastern, with their co-op program. It may well be at community colleges wherever it is, our ability to create human capital through higher education is the key to success in America. And President Obama has said it very well, and I've got a quote from him. He says, "The source of America's prosperity has never been merely how ably we accumulate wealth, but how well we educate our people." It is very important to have a president who understands that and who articulates that. So against the backdrop of what I've just laid out, why am I optimistic about higher education? And I'll tell you a short story about another institution, which is Middlebury. The president of Middlebury notes that higher education communities often face some difficult situations, and his own institution in 1880 had a very difficult time. Their enrollment had declined, their funds were diminished, their facilities were in disrepair. The embattled trustees got together and said, we must do something. We must take a drastic step, a drastic step. And who knows what drastic step they took? Does anyone in the room know what they did? In 1880, Middlebury took the drastic step of admitting women. Clearly not a drastic step at all. Clearly very insightful and very foresightful. And I bring that out because it's quite clear to me that higher education today, with the same challenges that Middlebury faced in 1880, will step up, will be foresightful, will be insightful, and will play a very, very important role in helping the U.S. economy right itself, in educating the next generation, and in helping them to avoid some of the mistakes and problems that we have had. So thank you very, very much for your attention, and I look forward to answering your questions as best I can. Thank you very much.